Okay, good afternoon guys, welcome to this debrief for Wednesday the 19th. Okay, our objectives, fundamentals as usual. We'll have a quick look at the economic calendar. We're then going to move on to today's US CPI. We're going to have a look at the number, try and break it down, have a look at the market movement and talk a bit about that. We're then going to move on to the FOMC and discuss tonight's minutes. And our quiz question is, what is your trade plan for the FOMC minutes? So let's move straight into it. Where I'm going to start today is I'm actually going to go a step backwards, and I'm going to move one step back in this debrief. Okay, and I'm just going to show you something how, almost a follow-on from yesterday. We spoke about yesterday, we said how we came in the morning and all we saw was minus 6% in the Shanghai index. Okay, now if you cast your minds back to yesterday, I said to you guys, it's very important sometimes to form some sort of a, not necessarily a bias, but some sort of a, a lean towards one side or the other. And like I said, most important is to not look at the Shanghai in solidarity. Okay, you've got to look at the markets as a whole, not as one. Okay, and we spoke yesterday. We said, had you had a look at the negative 6% in Shanghai, what were the other markets doing? So, what was the Nikkei doing? What was the yen doing? What was the gold doing? Okay, what was the S&P doing? Okay, we broke it down. We said, well, the Nikkei was down 0.4%. We said the yen was relatively flat, gold was relatively flat, and the SPUs was down, I think, one handle. So relatively flat. We broke it down and we said, well, the reason that it wasn't that significant was simply because it hadn't spread to global indices or other markets. In other words, the market was almost shrugging off the fact that the Shanghai was down 6%. Okay? Now you come in this morning and suddenly the first headline in the FT is Shanghai, and I'll get there. In fact, let's pop it up quickly. Okay, the headline first up this morning was China's stocks hit by renewed volatility. Shanghai and Shenzhen reversed steep falls in choppy day trading. In other words, the Shanghai was down 3% on the open. Okay, headline newspaper, another 3%. Now, if we go do the same analysis as what we had done yesterday morning, you would have seen very differently the Nikkei was down 1.4% this morning. Okay, the Hang Seng was down, the yen was well bid. Gold was well bid, and the S&P was down, I'm trying to think, it was down quite a few handles this morning, 5 or 6 handles. Okay, can you guys see the difference? Can you see the difference in this situation, something like the Shanghai being down 6%, okay, is not filtering through to other markets. Therefore, it's not that it's not significant, it's that it's not necessarily market moving right now. Whereas in today's situation, okay, we could see there was far more significance being paid attention to, not necessarily what the Shanghai did, but what had happened in the Asian session. Okay, you understand that? Now, the reason I'm starting here is because I want you guys to understand what the clear theme across the market is today. It's very simple, right? We started the day off with the emerging markets being very, very positive. They're not very positive. They were doing well. A little bit of a relief rally in the emerging market currencies. At the same time, okay, if you look at the equity markets, and by that I mean European equity markets, they've done what we call typically a range gap. Okay, what's a range gap? Very simply, if this is the previous day's range, a range gap is just simply where there's very little overlap between the 2 days. That's a range gap. In other words, value was accepted there, and it's now been accepted totally lower. Okay, that tends to be a bit of a bearish, bullish type signal, depending which side it is. The bond markets, okay, generally all day we're balanced. Right, then we look at gold. Very strong bid in gold today. Very, very strong on the day. We look at the yen. Okay, nice strong update in the yen. Okay, so if we just break it down, guys, if I just drew a grid with emerging markets, equity markets, bond markets, gold and yen, you're going to get a very good feel for what's going on in these markets as we're speaking. Okay, there is a traditional risk off theme across the markets. Now, the reason I'm pointing this out, guys, is because when these risk off themes begin and when they start, okay, they don't stop necessarily after one day. Okay, so again, use those indicators when you come in tomorrow morning. Look how Asia responds to the end of today's session. Okay, you can bet your bottom dollar Asia's going to be weak tomorrow. Okay, how do those emerging markets fare overnight, early tomorrow morning? Right, make sure you are prepared for tomorrow, guys. There is something brewing in these markets. Today was the first time we've seen a real risk-off flow across all the markets, a genuine risk-off flow. Okay, now, again, the reason I start here is because I need you to understand the context of the market before we talk about the FOMC. Right? Because if you understand the context of the market today, it's going to guide you as to your trade plan for the FOMC minutes today. Right. Lock that in the back of your head. Let's quickly get through the fundamentals and then we'll come back. Okay, so China stock volatility. Okay, we've spoken about that. I'm not going to spend too much time on it. What I do want to point out is the China fix, okay, kept steady. So they fixed at the same rate again. All right, now keep in the back of your mind, the Chinese government is all too aware that they want to remain supportive of the Chinese stock market. So again, they may not fix it differently tomorrow, but if they do, you know how to react. We spoke about this yesterday. Okay, let's move down a bit further. Okay, so Bank of England. Right, we spoke yesterday and we said how we had the all-important Bank of England inflation numbers. Now, effectively, Bank of England's Miles has come out overnight and he said that effectively turning to the point on rates, it's coming, his rate hikes are coming pretty soon, and hiking is a sign of economic strength. He then reiterated that the new normal UK rates will be well below historical levels. Can you understand what they mean about that when central banks are talking about hikes being below historical levels? Does everyone understand that? Quickly nod your head. Yeah, you all, is there anyone that doesn't understand it? Otherwise I'll show you a drawing of what they mean. Yeah, you're all happy with that? Okay, so let's move on and then talk about the US CPI. Okay, so expected today, we effectively expected a number of 0.1 on there, month on month. Okay, this has got all funny. But the important one, we spoke about this yesterday, guys. Remember, the important focus is not the month on month. Okay, it's the core data, but more importantly, the year on year core data. Right? The reason the market tends to pay more attention to the year on year is because it's a little bit more stable than the month on month. Okay, the month on month sometimes can be influenced by various factors. As we can see, we had a 0.1 miss on both the headline and the core month on month. Net result, okay, pretty stable. Now what I do want to mention to you guys, remember we said the market is not sensitive to down or misses in inflation. It's sensitive to beats in inflation, simply because it brings forward the potential for an early rate hike. Right, let's have a look at the market and let's see how the market responded to the miss. Okay, so yeah, we have the US 10-year. Okay, now bear in mind, I'm always going to show you the market that is most sensitive to the data. Right, I could show you the dollar, it'll be a very similar pattern, but remember, US inflation is going to affect the US 10-year part of the curve the most. So, the number comes out on this big candle, we can see the market blips up on the miss, the algorithms take it up. And within 2 minutes, we are back at the starting price. Now, for those of you that have been around a little bit longer, for the more senior guys, you know the reversal trade, okay? It's a very, very good trade opportunity, right? It's simply the entire market or the entire local community goes long on a 0.1 miss, thinking the market's going to extend to its highs, and once it gets back to the starting price, the market then stops everyone out. Okay. The important thing is not so much necessarily had you sold it there or anything like that. What I want to point out, guys, is that this is the second time now that we've seen US data that misses, in other words, that should go to the upside. It's the second time we've seen someone utilize the data to initiate a position. Okay, and it's twice now in 2 weeks that we've seen someone selling into bad data out of the US, or data that should make the bonds go up. Okay, lock that in the back of your head, guys, because we've got an NFP coming out in 2 weeks' time. Right? And what I will say to you, and I will reiterate it on that day, is that it does seem as though there is positioning for the September meeting coming. Okay, and it's it's not very obvious, but when you see a market blip up and suddenly someone just steps straight in to sell the market off that, right, it's starting to indicate that someone is utilizing the data to get volume off. Right, now don't be surprised if you see a similar type play in the September NFP. Okay. We'll keep an eye on that. Just note, obviously, the market consolidated a little bit and had a second go. So quite an aggressive down move, guys. Very, very aggressive, given that it was a 0.1 miss. Okay. Now, yes, I know Dan made mention to the wage component. Okay, that effectively the 0.4. Yeah, it could have been. Okay, it could have been. Anyone's guess. Right, but the important thing is we don't pay attention so much to that. What we do is we plan and prep according to what we can do, right, and then we execute according to what we see. All right, do you all understand that? You all got that? Okay, that's the UK CPI. Let's move on. You guys are all nodding. You want to get done quickly today? Okay, very quickly, let's have a look at the calendar for tomorrow. So very briefly, we've got nothing but UK retail sales. Okay. Bear in mind, Tuesday we had the 0.1 beat in the CPI. Okay, the market was very sensitive to positive data or data that leans towards a rate hike sooner. Okay, so again, if you come in tomorrow, we get a very strong retail sales number, right? That could give the pound the necessary bump to the upside that everyone's talking about. Okay, a lot of analysts are talking about that pound looks ready for a move, a sustained move up to 159. I know Reg also mentioned today, and he was spot on in his analysis. Okay, if you look technically at the pound, it looks as though 159 is on the cards in the days and weeks ahead. Right, so it may just be a case that it needs a little kick from the retail sales. Other than that, guys, no real risk out for the rest of the week. Tonight is the final risk event of the week. Okay. Let's move on to the FOMC. For those guys joining on the outside, please just, if you've missed the first part, just go back to what I was talking about in terms of the pricing. Okay, so where we're going to start is the previous minutes. Okay, when you look at the minutes, sorry, not previous minutes, previous meeting that should read. When you look at the minutes, guys, make sure you understand a summary of the previous meeting. That's the best way to go into these minutes prepared. Okay, you have to understand what was the interpretation the market took from the statement. Okay, because if you understand that, then you want to look for answers. You want to look for the Fed to describe what it told us in the statement. Now, the highlights effectively of the meeting was that it was mostly a non-event, guys. I wouldn't even say mostly a non-event. It was a non-event. But for some reason, they included the silly little word, some. Okay? And the market took it as a very hawkish signal because effectively the market thought that if there was some further improvement in the labor market, that meant the Fed was likely to hike in September. Okay, that was the idea the market got behind the silly little four-letter word being added, some. Okay, so today, guys, we want to find out what did they mean by that some. Did they actually mean that if we get some further improvement in the labor market, that means we're on for a hike? Okay, if that's the case, bear in mind we've had the August NFP, which was mostly in line, right, and we've only got one more NFP in 2 weeks' time. Okay, so that was the first thing. The second thing, obviously, is we only had, well, as of before today, we had two CPI numbers. We got one of them today. Okay, again, it was in line on expectations, and we've got one more before the September meeting. Right, you all understand? So that was effectively, guys, and then obviously data dependent. That was the summary of the previous meeting. Okay, so what the market's looking for today is some sort of an interpretation, some sort of an understanding around that word some. If they come out and they tell us that some meant that yes, if the labor market keeps going as expected, it's likely we're hiking in September, the market will take it hawkishly. Anything other, guys, if they come out and they sort of almost downplay or don't really make any mention as to why they added that word, the market could effectively take that as a little bit dovish. Okay. Now, the current situation, and this is the important thing to understand, guys. All right? Remember, the minutes are 2 weeks old. This is the thoughts of the members 2 weeks ago. A lot has happened in 2 weeks, and that's why we go and have a look at the current situation of the market. All right? The first thing, there's a 50%, roughly 50% chance of a rate hike priced for September. Okay, so in other words, the market is not fully pricing a hike, nor is it not fully pricing a hike. So if they came out right now and said hike or no hike, the market would move aggressively one way or the other. And that's why I want you guys to start thinking about this meeting in how many days' time?
29.
Okay. Why don't you get your phone out and calculate the number of days? Is it 29? So we got 29 days. Guys, write that down. 29 days to potentially the biggest opportunity of our careers. Okay, listen to me carefully. The market's only priced a 50% rate hike for September. So what that means is if they hike, the market has to aggressively put the other 50% in place. If they don't hike, the market has to reduce that 50% chance. Do you understand that? That means regardless of what they do, we make money. Okay? You guys should be excited about that idea because we make money regardless. We don't care. We will make money though. But we have to be prepared. Okay? So let's move on. China. The second big change of the last 2 weeks is that China's now come out and they've effectively devalued their currency. The first time in many, many months. All right? The Fed would not have known this. They might have, but they're not going to make mention to it. Okay, so you've got to ask yourself, well, the Fed might be very hawkish on the outlook, right? Yet all of a sudden, China's thrown another curveball. Right? Equally, the Shanghai's just dropped, what, I think 9-10% over the last 2 weeks. Okay. Then, oil, guys. They've constantly made mention that inflation in the near term is being affected by transitory things like the stronger dollar, like the oil price. So suddenly, the dollar's stronger over the last 2 weeks, and the oil price is down by $5. So again, these near-term transitory factors are still at play, even more so than they were 2 weeks ago. Right? And then the guinea pig, something that's not really being flagged as much as it should be, but emerging markets are in trouble, guys. You can't see it because you don't watch the grid. I will put the grid up for you and show you the charts. Okay, I will show it to you in the FX and commodity rundown on Friday. Right? But the emerging markets are being sold aggressively, guys, as in proper aggressively. Okay, and these are three factors that the Fed will be aware of, but also the Fed will be discussing in 29 days' time when the meeting comes. Okay, so now we move on to the market reactions and a bit of scenario analysis. So the first thing to understand is what we spoke about at the beginning. The market is going full-scale risk-off into this. Full-scale, guys. Okay, so you have to make sure that when you prep and put your plan in place, you have to understand that there is already a technical play in the market, which is risk-off. So the simplest trade and the easiest trade is if the Fed comes out and they say something that is perceived dovish and it makes the US equity markets go bid. That could give all of us a very easy opportunity to get shorts off in the US equity markets. Why? Because the markets are risk off today. In other words, it would take something significantly dovish to get the S&P to unwind this very aggressive sell side action. You all got that? Okay. Equally, if we look at the US bonds, remember they sold off aggressively over the data, but they've reversed the entire move. Right, so continuing that theme of a balanced day in the bond markets. Right, the gold is particularly strong today. Okay, so again, if something were to come out, and there was a dollar positive or a dollar negative, right now we can see that the euro is bid, the yen is bid, and the gold is bid. In other words, if they say something dovish that should make the dollar sell off, we should see the yen rally aggressively, the gold rally aggressively, the euro rally aggressively. On the counter, if they said something that was particularly hawkish, okay, we'd far rather prefer this to sell maybe the pound, which is sitting on the low of the day and it hasn't quite responded in the risk-off environment. Do you understand how I did that, guys? Understanding what's going to be the easiest market to trade in which environment. That's part of our job, because that's what's going to give us best opportunities to trade come 7 o'clock tonight. Okay, we all got that for the FOMC. Remember, the minutes are 2 weeks old. So there is a high probability you're going to see a lot of reversal trades tonight. That is the general tendency, is for reversal trades, unless they say something significantly unique. Bear in mind, the Fed has not wanted to say anything unique for many, many, many months. Why? Because they want to give themselves the option to either hike or not hike. They don't want to commit too early. Okay, so just keep that in the back of your mind. But don't forget, okay, strange things happen in this job. Right, there may be something that comes out of those minutes tonight that signals effectively the Fed is going to hike. So just be open-minded, be willing to, even though it's late in the day, be willing to be aggressive if need be. Right. In terms of your ladder setup, and this is where we'll finish, make sure you've got a deck 16, deck 17 ladder up. Okay? The stirs will give you the biggest and easiest clue if the Fed signals something. Then make sure you have a dollar product up. So I'd recommend either the gold or the euro dollar. Okay, those are the two best dollar products because they move the most logically. Then make sure you've got the S&P or the NASDAQ. Right? And then also make sure you've got a US bond market up. Okay. The last thing I want to point out, don't don't fade markets after hours in a risk off or a risk on environment. What do I mean by it? In other words, what we're seeing in the European equity markets today is a general risk off. They're 2% down across the board. Okay, so don't sit there looking for support, not after hours. Why? Because you're not going to find support. The cash market's shut. The big Goldman Sachs, big banks, they're not there to try and support the market. Okay, the clients that put the orders through are out to dinner. Okay, so just keep that in the back of your mind. Don't fade markets after hours, because all you're going to do is put yourself in some nasty positions. Okay, go with the flow or sit out and sit on your hands and take it easy. Okay, that's the FOMC. Let's wrap up and get to the end of it. Okay, so to finish off today, guys, just our quiz question. All right, what is your trade plan for today? Remember what I said to you yesterday. I can't stress this point enough, is that you're all competing against me. And I can promise you, if I knew any one of your weaknesses in here and you sat next to me, I would take advantage of that. I would exploit that weakness every single day. Okay, because that's our job, guys. Our job is to be that little bit more intelligent than the 91% of people that fail. Okay, so keep that in the back of your mind. Keep, every time you feel lazy, every time you feel unproductive, every time you start playing Candy Crush, it's understandable, we all get distracted. Okay, but every time you do that, just somewhere in the back of your mind, maybe write it on your desk, or put a little piece of paper on your computer. Write that 91% and that 9%. Because if you want to succeed, guys, you've got to be doing what the 9% do. I can promise you, the 9% aren't sitting there playing Candy Crush. Okay, the 9% aren't sitting there wasting their time. They're being productive. Okay, they're thinking of new ideas, new ways that they can extract money out of the market. Okay, good luck for tonight. Take it easy, and we'll come back tomorrow.